The EU AML framework does not operate in isolation. Alongside the directives and regulations that form its core architecture, a set of adjacent legislative instruments address related risks, enable data access, protect reporting individuals, and expand the scope of predicate offenses. These are not peripheral documents. They are instruments that compliance professionals in the EU must understand, because they create obligations, tools, and protections that directly affect how AML programs are designed and operated. There are 9 instruments to know. They fall into 3 thematic clusters. Cluster 1, Sanctions, Crypto, and Anti-Fraud. Cluster 2, Data Resilience, Protection, and Access. The third cluster covers tax cooperation, corporate sustainability, and whistleblower protection. For each instrument, number, date, name, and AML-relevant provision. All 9 are testable. Directive 2024/1226, adopted in April 2024, identifies EU sanctions violations as a predicate offense for money laundering. Before this directive, these were often legally distinct. Now, proceeds from sanctions evasion can directly trigger money laundering prosecutions. This connects sanctions screening and AML monitoring at the criminal law level, not just as a regulatory obligation. Institutions failing to report sanctions evasion patterns now face potential exposure under the AML criminal law framework. The message is clear: sanctions and AML compliance must be integrated, not siloed. One program, 2 frameworks. MiCA, Regulation 2023/1114, adopted May 2024, is the European Union's primary framework for crypto asset markets. Critically, MiCA does not address AML and CFT directly. Its primary purpose is market integrity and investor protection. However, it is AML relevant because it establishes the internal controls that make those programs work. MiCA requires crypto companies to maintain comprehensive internal controls, specifically governance, risk management, and operational procedures. These create the institutional infrastructure that makes AML obligations meaningful in practice. A crypto company with weak governance and poor internal controls cannot run an effective AML program, regardless of what the policy says. MiCA authorizes all crypto asset service providers. Once authorized, those entities become obliged entities under the AML regulation. The 2 frameworks are explicitly connected. MiCA creates the regulated perimeter and the AML regulation applies within it. This combined approach ensures a robust regulatory environment for the entire crypto asset sector. The third instrument in the first cluster is Directive 2017/1371, known as the PIF Directive. Where PIF stands for the French phrase Protection des intérêts financiers de l'Union, the protection of the financial interests of the Union. It was adopted in July 2017 and harmonizes criminal law provisions to fight fraud, corruption, and the misappropriation of EU funds. It also covers associated money laundering. The connection to AML is direct. The PIF Directive criminalizes associated money laundering. This means that proceeds from EU fraud, like misappropriation of structural funds or agricultural subsidies, are within the scope of money laundering criminal law. The connection is rooted in the protection of the EU's budget expenditure. The EPPO, the European Public Prosecutor's Office, has a primary mandate to investigate and prosecute PIF Directive offenses. This is why the connection matters. EU fraud, corruption, and the EPPO's mandate all derive from the same foundation. Operation Admiral is a key example. VAT fraud prosecuted under the coordinated jurisdiction of the EPPO. The second cluster covers 3 instruments that govern how data is protected, accessed, and secured in an AML context. The first is Regulation 2022/2554, the Digital Operational Resilience Act, known as DORA, adopted in December 2022. DORA's primary purpose is to ensure that financial institutions can withstand, respond to, and recover from ICT-related disruptions. The AML relevance is indirect but significant. First, it reduces the vulnerability of financial institutions to cyber-enabled crime. This is the category of offense that TrackFin identified as generating 31% of STRs from payment institutions alone. Second, it ensures that the systems used for transaction monitoring and customer due diligence are resilient and functioning as designed. A transaction monitoring system that is unavailable because of a cyber attack is not a functioning AML control. DORA makes operational resilience a regulatory requirement, strengthening the infrastructure on which AML compliance depends. Directive 2024-1654, adopted in May 2024, guarantees direct access by competent authorities to BARIS. The Bank Account Registers Interconnection System is a centralized EU system identifying which institutions hold accounts for any individual or entity. Before direct access through BARIS, law enforcement and AML investigators had to submit requests to individual institutions or national registers. This process was slower, more fragmented, and more easily evaded by sophisticated criminal networks that deliberately spread activity across multiple institutions in multiple member states. With BARIS access, a competent authority can determine the full account footprint of a target across the EU with significantly greater speed. Directive 2024-1654 also requires obliged entities to provide transaction records in a standardized format. Standardized formats make the data more actionable and reduce the analytical burden of working across incompatible reporting structures. The third instrument in the data cluster is Regulation 2016-679, the General Data Protection Regulation, universally known as GDPR, adopted in April 2016. GDPR and AML create a tension that compliance professionals encounter regularly in practice. AML obligations require financial institutions to collect, retain, and in some cases share significant volumes of personal data. GDPR simultaneously establishes strict rules about the lawful basis for processing personal data, the purpose limitation principle, data minimization, and retention periods. The resolution of this tension is provided by Article 6 of GDPR, which establishes the lawful basis for data processing. Financial institutions are permitted to process personal data for AML purposes under Article 6, specifically under the legal obligation basis and in some cases the legitimate interest basis. This means that collecting a customer's identity documents and running searches are all lawful under GDPR when done in compliance with AML obligations. GDPR also ensures that AML data processing is proportionate, secure, and subject to oversight. These requirements prevent the AML framework from becoming a vehicle for disproportionate surveillance. The two regimes are complementary. The third cluster covers instruments extending AML obligations, starting with Council Directive 2011-16 EU, known as the DAC. Adopted in 2011 and repeatedly amended, DAC establishes the framework for automatic exchange of tax information between EU member states. Crucially, information exchanged under DAC can be used for AML and CFT purposes and for compliance with EU sanctions. Tax information, like income flows and asset declarations, is often exactly what AML investigators need. It helps build a picture of unexplained wealth or hidden assets that might otherwise remain concealed. DAC creates a legal channel through which that information can flow between tax authorities and AML authorities. The second is Directive 2024-1760, adopted in June 2024, known as the Corporate Sustainability Due Diligence Directive, or CS3D. This requires large EU companies to conduct due diligence on their supply chains regarding forced labor and environmental degradation. This indirectly relates to AML through overlap with KYC and beneficial ownership checks. Note that CS3D is still subject to modification. The final instrument in this curriculum is Directive 2019-1937, adopted in October 2019 and known as the Whistleblowing Directive. It provides protections to persons who report breaches of EU law, and it explicitly covers AML and CFT reporting within its scope of protection. For financial institutions, the Whistleblowing Directive creates a mandatory obligation. All financial institutions are required to have internal hotlines. These are confidential reporting channels through which employees can raise concerns about potential compliance breaches without fear of retaliation. The directive protects reporting persons from dismissal, demotion, discrimination, and other forms of retaliation. This protection applies whether the report is made internally, through the hotline, or externally to a competent authority. The practical implication for compliance programs is that the hotline is not just a governance checkbox, it is a source of intelligence. Employees who observe suspicious activity or internal pressure represent a potential source of early warning that formal monitoring systems may miss entirely. An effective internal reporting culture is part of a robust AML program that completes the EU AML regulatory framework.